4 million rev. So they would sell it for 10. But had they done 2 or 3 different things, their exit would have been $50 million.
Yeah.
So they left 40 million bucks on the table just
Yeah.
of basically how the business was set up, how it's structured, and then also how the assets are positioned. It's mind blowing. And I'm like, that's some bones, man.
Welcome back to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers, co-host Ian Horowitz from Equity Warehouse. Today, we are going to be interviewing a repeat guest. His name is MC Laubscher from Producers Wealth, and we're going to go a little bit more high level on this. You know, I think a lot of our audience and our viewers that have watched the show and supported the show, they like, a lot of the good feedback is they like when we hear a little bit more kind of higher level stuff. And we're going to talk about positioning your capital like a family office does. It's a topic that Ian and myself talk about kind of all the time. And I think there's a lack of knowledge out there for a lot of real estate investors and entrepreneurs and business owners. Sometimes it's a lonely industry and you don't really know or have the resources to do so. And, Ian and I are always talking about family office, infinite banking, legacy assets, wealth, things like that. So that's going to be the topic for today. We also want to dive into MC's new book called Get Wealthy for Sure, the #1 financial strategy for business owners to multiply wealth predictably. So we're going to talk about that today too, Ian.
Yeah, no, I'm definitely excited. I just had a windfall on the sale of one of our properties. We're getting ready. By the time this comes out, we'll be closing another property that we filled up super fast through one of our offerings. And I was able to watch the whole thing work. I borrowed money from my bank. I put it into an investment. It then produced dividends, and now I recycled the capital and I get to do it again. And it was like an oh shit, holy crap moment. We've had a few other guests recently that have been talking about this policy. And it's just funny how it's interactive in everybody's business and not everybody talks about it, but this is the stuff we're supposed to be talking about. Literally this past weekend, I was texting Jason. I said, oh, great. I'm down in a Nelson Nash documentary, but it's the second or third time I watched it. And I just got more and more value out of it. I was like, wow, what a genius. And really started to learn about this. And in the end, it's all about taking care of your family and your family office. So this is exciting, but guys, it's not about us. We don't care about the likes or the subscribes. What we do care about is the shares. If you get any value out of this episode, which I guarantee you will, please feel free to share it. It's the best compliment we can give our guests. Enough about us, because we have 1,000,000,001 questions, so this should be a fun one. Let's bring MC in and get this ball rolling. What's up, brother?
Great to see you guys.
Yeah, man. Welcome back. It's not often. I can probably count on our hand how many repeat guests we have. So we take that very seriously. So we're super excited to have you back and excited to take this to the 201 level. And most of our audience probably knows by now what infinite banking is. So if you just want to give just a little background on you and kind of the infinite banking concept, and then we can take it to that 201 level almost immediately.
Yeah. So name is MC Laubscher. I'm the founder of Producers Wealth, where our mission is to elevate the financial well-being of business owners and their families. So we operate in all 50 states in the United States. And I'm also the founder of the Cash Flow Ninja podcast, and now it's an educational company. So I've been doing that for 8 years now. We've interviewed the best minds of business and investing, and researched over 100 different ways of how to create cash flow and grow your capital. Originally from South Africa, I played sports. That's what landed me in the United States. And while I was pursuing a career in sports, I started buying real estate in 2001 after reading Robert Kiyosaki's Rich Dad Poor Dad on the road. I took action to bought my first property then, put tenants in the property, collected the rent, and it was boom, like just a bolt of lightning that just hit me cash flow, just like in the book. And at that stage, I try to figure out how many times can I do this? Because if I can scale and grow this is going to be good. In that process, I learned, one of the other most valuable lessons that is in Rich Dad Poor Dad, The first lesson is cash flow, right? And obviously there's a ton. We could just throw them out. You know, the rich doesn't work for money. They work to learn, and so forth. But the lesson that he doesn't say out loud, which I came across as I reread it, like probably the fifth time. I read that book every year. When the student is ready, the teacher appears. So the big lesson that I didn't see the first time was that all of the liabilities that you constantly have is the assets of someone else, and it's the bank. And then I started to recognize, oh boy, you got to be a bank. So yeah, cash flow is great. Yes, and being a business owner and entrepreneur is great. Building things is awesome, and helping other people are awesome. But there's another level to this game. If you are a business owner and you're just running your business, or you're an investor and you're just investing, it's very one-dimensional in this game. As much as you think it is, there is many more dimensions to it. When it becomes 2 and 3 and 4 and 5 dimensional is when you start adding levels to it. So be in the business that you're in, invest in the asset class that you're in, and grow and scale that portfolio, but be the banker. You got to be the bank and reclaim that function. And that's, down that road I discovered through a friend of mine that actually had a family office structure, the first time of how you can become your bank. Fun fact, they actually owned a bank, like literally. They were shareholders in a bank, but they didn't keep their money in the bank. They had other people's money in their bank. They had their own family bank as part of their family office structure, which they warehouse it in, according to the infinite banking concept. And of course, then I came across Nelson Nash, Becoming Your Own Banker. That's another book I read every single year. Same with Rich Dad, Poor Dad. And Nelson became a mentor of mine, and what an incredible man. We were actually working on a project at the together at the time he was passing. He's great. But that's kind of like, been the process of, and where I'm at right now too, and what I'm studying and getting in the weeds in, and just absolutely immersing myself in, is family office structures. Going through the process of trying to copy what they do in family offices. My mantra is, you don't have to be a Rockefeller to do what the Rockefellers do. You could create the same setup and structures and have similar results, just obviously at a different scale and a different level. And I'll just finish with this for folks that are not familiar with the concept of a family office. So a family office is a wealth management firm of the family, managing the family's wealth. So where, even an ultra high net worth person would have a tax strategist, CPA, maybe a tax attorney. They would have, an asset protection advisor. They would have an estate planning lawyer. Maybe they'll have a financial advisor and an insurance planner and so forth. They're all siloed, right? They're separated. Where in a family office, these are all under one roof, working for the family, on the business of the family, because you're running the family as a business at that stage. This concept was popularized by the Rockefellers in the United States. They actually came up with the term family office, and they copied the Rothschilds and other families in Europe. So just wanted to share that too.
Yeah, definitely want to dive into that here in a second. Let's talk about one thing, kind of back up a little bit. Like, I think there's a common misconception that a lot of investors, and specifically real estate investors, take, where they save $100,000 and they go buy a property in cash, or they save some bucks and they go buy an apartment building and they put down 25% and they leverage the other 75%. But I think, part of this, the infinite banking, the family office, be your own bank concept is a little bit different. And I think people just aren't used to or accustomed to that. And it's a learning tool. And I get that. Like, kind of on a high level overarching concept, like how does that work? Is it more of creating, when we say IBC, infinite banking, infinite banking concept through whole life insurance policies and things like that, is it actually funneling capital that you've accumulated through life insurance policies first, and then doing policy loans out of that, in essence, to invest into those assets instead of just paying cash or getting debt from another bank?
Yes. So Nelson Nash told the story about that there's one pool of water on the planet. And I'll share that story with your listeners and viewers. So he said, look, there's really one giant pool of water. So you have all the different oceans that are all connected. You have the rivers that are connected to the oceans. And then you've got underground water, which in some way or shape or form, they end up with the rivers, which is connected to the oceans, right? So when the earth heats up, there's condensation. Cloud starts to form and it starts to build until it gets heavier and heavier and heavier, and eventually it breaks, it rains. And where does the rain go? Into the oceans that are connected, into the rivers that are connected to the oceans, onto the land, which then goes through into the water in the underground water table, which is connected to the rivers and connected to the oceans. It's one giant ball of water. Now take that to money. There's really one giant pool of money too. And the banks, the commercial banks especially, has got this game figured out. So what do banks do? They run money through their banking system, position capital efficiently, collateralize it, and then issue loans and put it into vehicles that generate the private lend, just more publicly lending because you're a bank, to other entities, right? But they also always capture the value first. And the one thing about the banking system, if you think about it too, there's one giant pool of money, same as water, because if the three of us go out and we have dinner somewhere and a couple of cocktails, of course, at the end of dinner, maybe I'll be a nice guy and pick up the tab. And what will happen there is the money's coming from my bank account all of a sudden into the merchant account of the restaurant or the place that we're eating or we're at, which is then used to pay employees going into their bank account. So it's always leaving and coming back. It's the same thing with mortgages. If you go to a closing table and buy a piece of real estate, maybe you got a check to take at closing from a bank. Well, where's it going? It's going to someone else's bank account. Always comes back to the commercial banking system. It can leave for a brief period, but it always comes back. Infinite banking can be structured and set up so that you create your own pool of capital, where you capture the value of all of the money that's coming into your economy, whether it be personal, business, or investment, and then you deploy it. But it's always coming back if you do it correctly within the system.
Yeah, that makes sense, right? And I think that's where the misconception is. And I know Jason had an aha moment maybe in the past few weeks of like, we got to exercise that capital to go through the policy to then redeploy, because our assets that we all invest in probably outperform a policy. Most likely, I would assume, right? Because they're paying 5 to 6% dividends. We're all trying to achieve north of 15, 20%, right? So we should be able to find deals to invest in. But the point is you're putting that to store your wealth, to earn a return, and you're almost your own fractional share bank to then be able to lend it back out to yourself while it's still growing in a compounding rate, even though we're invested elsewhere. And I think that's the common misconception that maybe people have of, how do you flow money through your policy and why? And I do have a 201 question to that is, someone makes $100,000. How much in policies do they really need to be able to exercise these policies to do exactly what we're talking about?
So the first part of the question is no doubt. I mean, there is no return in the marketplace. If you have a business, if you're running a business and listening to this, and you're an operator and you're an investor, there's no way any return in the market can outperform that. Like, what are you going to get? An average 8% return in a mutual fund or an index fund somewhere? I mean, your listeners and viewers are not average people, and they're not looking for average returns, right? They're looking for exceptional things in all part of their life, whether it's health, whether it's family, whether it's experiences, whether it's their business, financially, and so forth. So yeah, so to your point, number one, there's the second thing is there's also what folks sometimes what holds people back is that there's a massive difference between saving and investing. Huge difference. And you can save and invest at the same time through infinite banking, But that it's very important to kind of hit that point, because savings is when you put capital into a vehicle with less risk. I'm not going to say there's no risk in anything. In business school, they used to say, yeah, it's treasuries, risk free. I'm like, yeah, right. I'm like, sure. But there's no place where there's zero risk, right? But in a savings vehicle, you take on less risk. And because you take on less risk, your return is more conservative. But the goal is, when you put money in a savings vehicle, the goal isn't at that stage to get massive returns or, moonshots. It's to preserve capital. Because in an investment, when you put money in an investment, you put money in investment with the goal to grow that capital and aggressively grow it. But by doing that, you also know that, hey, I could lose some or all of it, because there's more risk involved in an investment than with savings. So what infinite banking then does is, yes, you can save on the one hand in your own banking system, in your family bank, if you have it in a family office structure. And on the other hand, you can then lend it out to operating businesses which you invest in, or other investment asset classes or deals that you're trying to grow and scale your investment portfolio. So you're investing and saving. So you're doing two things simultaneously. So, if you think you have to choose and go, well, I could get like 50 to 100%. And I mean, like, sometimes it's crazy what people can do in their businesses and your own deals return. Why would I put it into something that's getting me, 4% tax free, right? That doesn't make sense. It does make sense if you think about that. You can get uninterrupted compounding tax free in that policy savings vehicle, and then invest it to aggressively grow the capital. So I would just say that. Then the other question that you had is, well, how much should people be looking at? So this is another, and I could see the mindset shift too since our previous conversations, because now you understand, when I say during a presentation, how much life insurance do billionaires and these family office buy? And the answer is, as much as these carriers will legally sell them, as much as they will sell them.
Yeah.
And a good rule of thumb is like 25% of your gross income, let's just say, is what a carrier will underwrite you for, allow you the premiums to put in. Of course, I did not consider your net worth, any of that stuff. When we factor that all in, we could come up with a completely different number. But that's just a good way of thinking about it. But yeah, once you figure out this system, then you realize, I mean, I heard it, 20 years ago, when that a friend of mine that had a family office structure set up and say they buy as much life insurance as they possibly can, as anybody would sell them. And I thought he was, at that stage, a crazed lunatic. Little did I know the other part of exactly why they have that mindset.
And going back to the topic of family offices, is this, so this is the common strategy for how family offices are set up as well, is right? Kind of leading everything into a life insurance policy first, then, hey, we're taking policy loans and in essence, getting that cash liquid again after it's already investment in this compound vehicle. And then, as the family office grows, the investments grow, and everything first though goes through the policy, through a life insurance policy.
Yeah, and I'll give you a quick overview just of like the 5 pillars that and core elements of a family office. So as I mentioned, it's a private wealth firm, a management firm. Now you could do the same thing. Obviously, you're not getting office space and bringing all those 8 advisors into that office space working for you tomorrow, right? But you can implement the same structures and then bring in the team together that's all on the same page. So the first core element is legacy assets. This is actually something that doesn't cost you anything. So what are legacy assets? This is the glue actually of a family and the family office. One of the things that struck me, everybody's heard the story of the Vanderbilt family and the Rockefellers and how they went through different ways, right? I'll put this in basically an elevator story for you, that the Vanderbilts were some of the richest family in the entire United States and world at that one stage. Cornelius Vanderbilt, the patriarch, built a fortune with these railroads and different businesses. the Biltmore estate is, of course, that's their one of the things that they're known for. Vanderbilt University still exists and so forth. But really, if you look at where the Vanderbilts are today, there are generations since Cornelius Vanderbilt was the richest man in the United States and the world that are dying broke and have no money. So take that in opposite with the Rockefellers, where similar thing, up and coming, the oilmen from Ohio, and then dethroning eventually the Vanderbilt family. And for generations, they have just become wealthier and wealthier with each and every generation. Now, Cornelius Vanderbilt, apparently rumored to have, some people say, allegedly said on his deathbed, to his son, which actually almost 10x the fortune. And then, a generation or two later, they were almost out of money. But said to his son, keep the money together. Now, that's a profound statement, because essentially that's what the Rockefellers did. But what did the Rockefellers do even better? What if Cornelius Vanderbilt said to his son, keep the family together? That would eventually have kept the money together too, as a result, right? So that's legacy assets. So statement of purpose. The Declaration of Independence in the United States is the statement of purpose of this country. Why? Why do we have this? The family constitution, the how. Just like the U.S. Constitution is the how of the country, the family constitution is the how for your family. Videos, a legacy library of life lessons that you've learned, so you can create stuff for your family in that. Then there's a family DNA that I call it the family DNA. What's that? How about a family crest? You could pull it from Europe if you're from a European family, but like my family, we've created our own one. And I've got kids that are, 7.5 and 6 years old. We had a lot of fun with it, and it was an incredible exercise. But it's who we are, what we stand for, what we stand again, all there. These are like all intangibles, right? So legacy assets. There's more in there, but those are some important ones and interesting ones. And definitely your statement of purpose, your family constitution, and your legacy library is in there. Blogs, podcasts, videos. Second piece is tax structures, your legal structures and insurance structures. This is something that you could set up as part of, a trust, where with each and every generation, and Jason, you mentioned the life insurance. This is the insurance structure, for example, that the Rockefellers have, is they would max out insurance basically on every generation. And as that generation passes away, there's a waterfall of capital to the next generation. And then that generation's maxed out, and there's another waterfall over. I mean, with proper legal, tax, and insurance structures, your children's children will never run out of money. It's impossible.
Let's talk about that real quick. Let's just talk about that real quick for listeners, because I get it and Ian gets it and you certainly get it. But but in essence, part of the benefit of why they can't ever run out of money is, you're funding these policies that in essence have policy loans and liquidity for cash now. But at the same time, there's also a huge life insurance policy associated with this. So even if you blow it one generation and blows all that money, it's going to get completely replenished, because the life insurance policy will pay back everything that, in essence was, was already used for instance. And, there could be millions of dollars, or a lot more than that, obviously, depending on how they're set up. So even if you have, let's just talk from one generation to the next. Like, even if you have a bozo generation where everyone's just not doing what they should be doing and making bad investment decisions, that policy that was set up from the generation ahead of them, or before them, I should say, will, their policy will cover the next, in essence, the next generation. And so anyways, keep going.
Yeah. And that ties into the family bank.
Yeah.
So that's a third piece. So you have your legacy assets, your family legacy assets. Then you have your tax, legal, and insurance structures, and that's connected in some way to that third piece, which is the family bank, that's where the life insurance policies are, and every family member gets a policy on them as soon as they're born. And of course, that that builds up this family bank in life insurance. And every family member, if they need capital for operating businesses or growing investment portfolios, they're going to the family bank. Now, in the family office, there could be a whole bunch of stuff that you could put in there that it's there for. For example, education, right? Education, starting businesses, buying properties, whether it be primary residence, investment properties, that kind of stuff. But it funds everything there. And to your point, are you going to have, a trust fund kid here and there? If you do a proper job with the family legacy assets and that intangibles, you'll reduce that probability. But no, of course you're going to have a black sheep in the family. But whatever they do, whether it's, boats and parties and big houses and cars, eventually the family bank will be made whole when they pass, and they'll actually be replenished with more capital that they could have spent. But that's at the core of this, is the family bank. And this is where infinite banking comes in. And that friend of mine that I mentioned, that they were shareholders in a bank with other people's money. This is their bank. And he was explaining to me, listen, this is what we do. We have operating businesses that generate cash. We put it in our family bank, which is all these life insurance contracts with mutual life insurance carriers. And then we take that and then we buy real estate with it. And we do that over and over and over. And then I'll just mention one more thing. Two, just briefly. The fourth piece is asset management, which is depending on your operating business and your investment strategy. That's what that is. And then the fifth piece is the family mastermind, where the family gets together, once a year, or we try to do it once every quarter, copying what the Rothschilds did in Europe. That's what they came up with, that family mastermind. Because in the book, The 5 Men of Frankfurt, the patriarch sent his sons all over Europe to all the financial centers, and they came back, had a family mastermind, once a year, and shared best practices and so forth, and made sure that the family's aligned, focus, and working on the purpose of the family.
Yeah, no, that all makes sense. And I literally was sitting here writing these down as you were going through them. And I didn't mean to rush you through 4 and 5, but 3 to me, obviously, we're business guys. It's probably the most like, okay, we're doing all this. How do we protect? You talk about buying on every family member. Me and Jason joke all the time, like, why does MC have 50 policies? Why do all these guys have 50 policies? And like trying to figure it out. How does one start? Like, I guess, like, I know we're trying to talk 201 topics, but it's like, I'm sitting here going, all right, well, I just had a nephew born. Like, do I buy one there? Then do I have to have a conversation with my brother to be like, this is how the family bank works? Or do you selfish, this sounds horrible, but selfishly do it for yourself, for your immediate family of you, your wife, and your 2 kids, as an example? Like, what's the best way to navigate all that? And as you can tell, you called it out, there's been a major mind shift change here in the past few months to kind of really take this even more seriously. So
yeah. So to your point, the first thing is, if you're going to start like family stuff, be very sure that everybody's on the same page. And this is what everybody wants. Like, we're going to do this. We're going to build, this little family bank, all of us together. And you kind of have to go through all of those different kind of like, I would say, core elements to make sure that this is something that everybody wants and everybody's on board with. Otherwise, you can just guide family members. If it's your brother, your sister, and they're married and they've got children, you can guide them and be like, hey, here's how you set up these things for your children and for yourself. So that's the one thing that I will say, is make very sure, be certain this is what everybody wants and on the same page. But where you basically start, and then I'll go to like a 201 level, where you start is, if you're listening to this going, I'm not a Rockefeller or a Rothschild or a Vanderbilt, and I wasn't born with a silver spoon in my mouth. Where do I start? You can start where you're at and set up a policy and redirect all the cash flows that are going in many different directions, what is not serving you, and try to put up to 25% of your income in there per year. And that is then used to fuel what you're looking to accomplish, whether it's like building out a real estate portfolio. This sounds so simplistic. I talk to people every day. They have millions of dollars in index funds, and they're like, I want to become financially free through real estate. And I'm like, I don't think your resources are aligned, buddy. We might have to reshift some things. And the same with business owners, where they're like, I want to grow and scale my business. That's great. Why is, I don't know, 60% of your net worth in stocks, providing liquidity for other people's companies to grow and scale? So that's the first thing. The second thing, like on a 201 thing, when you come into big exits and windfalls, there are different levels of strategies. Like I'll share a more an advanced strategy with you right now. We work with a lot of clients that are selling businesses and have huge exits. So it could be anywhere up from 5 million to 20 million to 30 million bucks that they come to us with and say, look, I just sold my business for 50 million bucks. I want to put at least 25 into this, to money that I cannot afford to lose. It's there, and I can access it if I wanted to. There's a strategy that in 5 years you can fund up a policy. Now, previously, it would take you 5 years to chunk it, to get it into the system, right? Long time. Now you could throw it into a side account, a supercharged savings account with an insurance carrier that funds the policy over 5 years. Now, what you can do is there are institutions that'll take that supercharged side account and the policy as collateral. So if you throw in 10 million bucks, we just had someone in their early 40s throwing 10 million bucks into this, they will be able to have a credit line of approximately 10 million bucks within the first 12 months. So this is a little bit more advanced, where there's moving pieces. So if you're listening to this and you go, I lost him, I have no idea what he's talking about now, all you're doing is moving a large chunk of capital into a savings vehicle, let's just say umbrella, into a mutual life insurance carrier, and you get a line of credit against it, which you can then go and use in your business and investments.
Yeah, and you're not taking your money out of it. You're taking a loan against your money and you're collateralizing it that way. So yes. I think that's one, and I think that's a common misconception of like, okay, well, if I put $100,000 in and I need to utilize it, then it's, that's not what it's doing. The 100, and yeah, there's some lag and there's premiums and stuff like that, but let's just take all that aside. Like in essence, if there's $100,000 in there, that $100,000 is earning compound interest, and you're taking a loan against that money in order to have that liquid. And yes, there's an interest rate that you're paying the insurance company to borrow that money. But again, let's use the word arbitrage. The money you're paying back to them is at simple interest, and the money that's growing is compound interest. And if you actually look at a simple interest versus compound interest calculator, you would be amazed the difference. So even if the interest rate's the same, it's not a wash. I promise you. It's amazing. I got something on my whiteboard right here where I did a scenario where it was $100,000 out at 5% and $100,000 that stays there at 5%. And the difference was it grew at $165,000 profit more over a 20-year period. And that's only $100,000, obviously. And it was tax-free compound interest too. So
it's wild that just that one difference. Just look at that massive difference in outcomes, right? Yeah. You want to be on the right side of compound interest equations in life as a rule. They're out there every single day. You are unknowingly in one, either in a favorable one or in an unfavorable one. If you educate yourself, you could put yourself in the position to be on this on the side that's more favorable for you.
Yeah, and that's more than just money. It's compounding interest in health, in life, happiness, conversations, whatever you're trying to do. It's all more than that. Yep. With the life insurance policies, I know we're talking about a family office essentially, and sometimes family offices have multiple families in it, right? Me and Jason both have business partners. How are you seeing business owners applying this structure of family office and or life insurance in their business to navigate buy sells or financing equipment? Like, you hear this, but like, how do you actually implement that? To me, that's almost like a 201 skill that needs to be discussed that nobody really elaborates on.
Yeah, I can dive into that. I'm in the trenches on that right now, working on a lot of business designs. So it all depends, again, how many partners, what type of business, and then also the goals of the business. So I'll give you a couple of examples. So let's just say you have two partners in a business, right? And what you're trying to do is there's some working capital in the business, but you don't have you have a buy sell, but you have no idea how you're going to fund that buy sell. And you're trying to figure out how to reposition more favorable as a business. So what you can do as a business owner is that the business can actually, and I'll share a different strategy after I share this one, because there's different ways of doing this. I guess the listeners will recognize that it's all very much based on exactly your unique situation. But let's just say the business can buy the life insurance policies on each partner, so that they have that in place, right? So now all of a sudden there's a way to fund a buy sell. So if one of the business partners, for example, passes away, right? There's a way for the surviving partner then to buy out the spouse that probably is not involved, nor do they want anything to do with the business. You can also then position capital. And we just, in one of the cases that I'm thinking about right now, it was a strategy where we put a large lump sum of this capital into, again, the supercharged savings account that funded these policies. These business owners could take those four entities, because you've got two supercharged savings accounts and two life insurance policies, all four, to an institution, and put one line of credit against all four. And it's now at 6%. So now they have it. So now these guys are like, this is wild. So now we're covered. If one of us dies, we're good. And also we have access to capital immediately with this line of credit, and our money in our business that have been just sitting there doing nothing is more positioned better. So that's one strategy of doing it. There's another strategy of doing it. So you can, and of course, I can get into how the taxes work, but that is really weeds on that one. That one, for example, there are tax implications. Not everything is tax-free. Yes, there's growth in it that's tax-free and so forth, but there are some taxes involved in that strategy. If you want to more have a black and white one where there's no, you're staying out of the playing the tax game very, very efficiently, you can take a distribution as a business owner, fund the policies outside of the business, and you can lend the money as the banker back to your business. So that's the other thing. You could set up a policy that which you own or the owner of, or your family trust is, that is the private lender to the business. There's a note. You would take a policy loan, let's just say at 6%, and give it to the business at 10, 15%, depending on what's reasonable. And they will repay, obviously, the principal and the interest. Now, let's just say you're a medical practitioner, you're a dentist, or you run a medical practice where there's a ton of equipment. This thing could really be powerful, because now all of a sudden you're the bank with a note that you get paid on. Your business receives the money, buys equipment, which they can depreciate, and then they repay the interest and the principal back to the bank, the lender, the private lender, which is you. So that's another one. Maintaining employees, as if you're listening to this and you're a business owner, keeping A players, I would say for most of the time, that's a tough one, right? A players are always looking to elevate their game. So they might even go and try and start their own thing at some stage, right? So how do you keep an A player, at least for a certain period of time? Well, you can set incentives aside using this strategy. So in your business, you can buy the life insurance policy. You could sit down with your A player and say, listen, here's what we're going to do. Here's our targets. If we hit our targets every year, that specific target, and it changes, but let's just say this year's target is X. We hit it. We'll put 50 to 100K in a policy for you here. But you've got to stay for 5 or 10 years or whatever you want to make it. You stay for 10 years with us. We keep hitting these targets and put it away. After 10 years, if you want to leave, you walk away with, 1.2 million tax-free in a life insurance policy, which you own, which will give you. I mean, that's not a bad incentive right there. And by the way, this happens in Fortune 100 and 500 companies every day. They literally structure CEO packages using life insurance and then stock options for them because they don't want to pay taxes. So they get paid in stocks and then this life insurance kind of strategy.
So you just do a 10-year fund insurance policy. So then at the end of that 10-year term, it's like, well, if they continue to do good, you can fund it. If they want to leave, then you just stop it and say, here you go, it's yours. So ingenious.
Well, I remember, didn't Jim Harbaugh do that with University of Michigan? Wasn't that one of the main stories that University of Michigan funded some policy for him? That was in essence the same thing.
Same thing. He walked away with millions of dollars tax-free. And he could actually access some of the money that they put in there was in the contract. Obviously, we couldn't see the private contract, right? But the way that I read the article is that if he needed a cash infusion or needed access to large amounts of cash, he could even get it through a policy loan. So, I mean, it's just all of these things, right, comes down to more efficient positioning of capital and playing this game a little bit smarter. Because sometimes when you're a business owner investor, you put your head down and you're so focused just in your lane, and that's why you're good, because you're so focused in your lane, and you don't see certain things. But when you step out of your business or out of your investment business and you look at, okay, what can I do a little bit better and a little bit more efficient here? One or two small tweaks. I mean, it's the difference between millions of dollars or just millions of dollars that went through your own economy. I'll give an example. A business owner, right? If you're running a business, and the reason why I'm sharing this is this is fresh. I just had this conversation with someone. So they were operating their business. They had money outside of their business in stocks, bonds, mutual funds, and ETFs. Well, very well diverse, right? Because they need to diverse outside of your business. That's the advice that Wall Street's going to give you. And at some point in time, you do, right? There's ways of doing this strategically and correct. But at this stage, they're still in growth mode. So I'm like, what are you guys doing? So let me ask you this question. Where do you go now to get money if you need to incorporate AI? That's like the hot thing, right? AI is just nuts. You incorporate in your business. I mean, it's going to give you a competitive edge, or hire someone else, or, bring on another product. Where do you get your money? Oh, I have a really good relationship with my private banker at the bank. And I was saying, so how much of these lines, have you looked at the line that you're using and what you're using all the time? And they said, yeah, we prepared for this and we're looking at our line. And I'm like, well, how much? And these guys were looking at like $300,000-$400,000 a year, just of like lines that they use, just operating and doing payroll and all those kinds of things, right? And I'm like, do you understand that if you put that amount of premium in a policy for like 10 to 20 years, just bare minimum, and you fund it correctly and you become your own banker eventually, because I asked them, what's your exit on this? And they're like, well, we're going to sell our business. We're going to get a lump sum, seller finance it because it's, tax efficient, that kind of stuff. And I'm like, imagine you sell this business for like 10 million. Okay. Imagine you sell it. Hats off to you. Congratulations. That's a good chunk of change right there for anybody, right? Congratulations. But what if I told you, like, for the next 20 to 30 years, you guys were your own bank, put the premiums away, and you walk away with $2, $3, $4 million tax-free in addition to that exit. And at that stage, the light bulb went off and they're like, well, that's kind of a no-brainer. I'm like, yeah, but doing it this way, your bank makes all the profit, your private banker, not your bank, your commercial bank that you're using. How about we restructure just your capital and now you become the bank, and then that $2, $3, $4 million that's tax-free is now yours instead of the profit of the commercial bank.
Yeah, no brainer. One more question, then I want to get into a little bit about your new book that you released. So, and I know this differs based on situations. if you're doing these policies and I think that's very relatable that people do these policies in their business, if it's themselves or they're or they have a business partner. Let's just call it a real estate investing business. Are they, and you might not know fully what the answer is, it may be different, but are you getting tax benefits on the premiums that the business is paying?
That's the other thing. You do not. So
Okay.
one of the things you can, again, but then just know this, that here's the deal with the IRS. At some stage, Uncle Sam, which is not your uncle's, getting paid at some stage. And if you try to evade that or try to dodge that leads to a lot of troubles later in life, perhaps.
Got it.
So I try to keep it black and white. Gray areas are areas that'll come back. If you have 87,000 agents at the time of recording, I don't know what it looks like next year. Could be little or zero. But if you have that amount of manpower behind you and people get bored, they come off to gray areas. So what I would do is, there's ways to not deduct the premiums, and that's obviously it could be seen as a negative, but I'd rather pay taxes now and not deduct the premiums than pay taxes later, or have there be some portion of the policy that's taxable later.
Yeah. So in essence, the business would be the owner, the insured would be the person, the business partner or the actual person, and then and in that case, is the beneficiary the business or the individual?
It all depends. This is where it gets technical, because you can look at the value of the business and this could be written into contracts, how much it would pay out if it's the value of the business, and or the business would recover cost, for example, on key person policies, and anything over that would go to a different beneficiary. So that's where it could get technical, where some could go to the business, some could go to the person that was insurer's family. It's all, how you structure it in contracts.
Got it. As we have a few more minutes, let's just talk about your new book called Get Wealthy for Sure. I got a copy in my hand as well, because one was mailed to my house. So who's kind of the target reader of this? A small business owner that, has accumulated some money and they're looking to kind of take the next step in kind of their financial path or financial strategy. Is that kind of the target?
Yeah. And I look at investors as business owners too, because you're running your investment portfolio as a business, right? So if you're in the business as an investor, your business is growing and scaling your investments, whether as a GP or an LP, right? So there's a lot of limited partner investors that they are very, very determined of scaling their portfolio and building it out. And because, they don't want to be involved in day-to-day operations. That's their business. So that's for them too. And it's the same principle and philosophy as if that's what you're trying to do as an LP and building and grow and scale your portfolio, why would you and get passive income? Why would you have all this money tied up in the stock market if you're trying to build, and this portfolio that generates passive income, that reduces your taxes and brings you the lifestyle that you want? So so that's who the book is for. The book, the big shift in the book that I'm trying to get people to realize is that, how you reposition assets that you already have could make a massive, massive, massive difference. In the book I talk about, how insane it was. If you just think about it, right? You're a business owner, a small business owner, a medium-sized business owner, you're an investor that is in the business of investing. How insane it is to still send your money to Wall Street because you're giving other people's businesses liquidity where your own business can use it to grow and scale. It's like, look, we love Apple, right? I have Apple products. I don't know if you guys are, Android guys, but yeah, Apple products, computers and so forth. Great company. They don't need my money. Okay. My own business and my own investment portfolio needs my money. Tim Cook does not need my portfolio to grow and scale Apple, right? They can go and get,
good point,
money at almost nothing. So that was the big point. And the big, spoiler alert, the big bomb that I try to drop in the book early to get people to realize, like, look, you have these goals, but again, you do things that are not in alignment with them at all, like something like that. And once you say it out like that, out loud, it becomes comical, right? But it's it's comical because it's the truth, right?
Yeah, no, it's they're all smart points. It's fun to watch people have mind shift changes, and I'm sure it's fun for you to watch us. It's fun for us to watch our friends have that mind shift change to get to the next level, and everybody should be thriving. That's what I tell people all the time. Like, you should be your own family office. Like you just said, you'll go give Apple or Elon all this money, but then you don't even think about it, rather than taking that time and saying, how can I do this more efficient to get better returns to allow me to quit my job, or whatever you're trying to do. Not everyone's trying to do that. So that's exciting. I read it once, and I think I have to reread it. I did pick up, I don't know, I got sucked into that damn Nelson Nash documentary with him and what's that, the Latin guy, Carlos something, and the other guy that's like the PhD. I bought their
Carlos
book.
Lara.
And
Yep.
the other guy, like
Bob
the
Murphy.
PhD,
Yep.
yeah, they sold me on buying their book. I was like, all right, let me reread this. So I'm getting on a plane tonight. I'm going to read that one, and then I have to get back there and reread yours. Mine's at home. I was just looking for it on my shelf, and reread yours. But MC, this has been an honor as always. It's fun to talk to you. You're a wealth of knowledge. Every time we talk to someone, they're like, oh, you're doing IBC. Who you doing with? Trying to get our business right now. We're with MC, and they're like, oh, don't worry about it. You're good. So I'm glad we got connected. What's one other book or podcast? I know you crushed it on Cashflow Ninja. You got a great book, but if you had to recommend another book, what would it be, or podcast that everybody should go check out?
Yeah, if you haven't read The Creature from Jekyll Island, I would highly recommend that. Because once you started to realize that you've got to become your own bank, as many of your listeners and your viewers have, and that was kind of my journey, is like, I've got to learn as much as I can about this. So that's a very, very opening book. It's written by G. Edward Griffin. That is just fascinating, of how the global banking system and then the commercial banking system works, how the financial system basically works. So, sticking with our theme of, there's a lot of compound interest equations in all areas of our life. When it comes to money, you want to be on the right side of them. And that'll help you, figure out how to get on the right side of that. But I always recommend that book. That book's has been a profound impact made on me on my journey.
I'm going to have to download that one. I've heard it several times. I haven't read it yet. Have you read it yet, Jason?
No, but it's another one of those long ones.
It's a big book. It's
25
a big book.
25 hours on Audible. That's
perfect.
But we can get that done in a month, Ian. We can hold each other accountable for that.
Yeah, we'll have to get it done here.
Yeah, I will say this: once you dive into it, I mean, you can't stop reading. It really pulls you in.
Good.
So yeah, it's a good one. I would highly recommend that one.
All right, game on. We'll have to download that one, check it out, get some of the listeners to read it along with us, and go back and review that here shortly. MC, I know you're all over the internet. I know some of your agents are all over the internet, but where's the best place people can find you? They want to learn more about what you're doing. They want to get a copy of your book. Where can they go and do that?
So if they want to grab a copy of my book, Get Wealthy for Sure, the #1 financial strategy for business owners to multiply wealth predictably, go to getwealthyforsure.com. You can request your book there. Just pay for the shipping. So there's a free book that you can request at getwealthyforsure.com. As you could probably allude to, the title of the book came from, I always keep saying there's no get rich quick, right? There's no shortcuts or get rich quick or cutting corners, but there is Get Wealthy for Sure. So getwealthyforsure.com. And then all of my podcasts, they're all available at cashflowninja.com, over 1,000 over there. And if folks want to learn and get into the weeds of just infinite banking and just access more sophisticated infinite banking strategies, they can go to yourownbankingsystem.com. It's yourownbankingsystem.com.
Yeah, and you get to hear MC's sweet accent for on all those fun tutorials on there. So if you enjoyed this, guys, if you didn't get any value out of this, I don't know what the hell you listened to. Please feel free to share it. MC just literally dropped bombs almost directly from Nelson Nash himself. I mean, this is powerful from a man who's experienced turmoil in other countries. He's now here. He can witness all this stuff. If you go back and find the other podcast, we talked about that way back on the other one. And dude, it's been a good one, and we will catch you all on the next one.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.